You are listening to The Investor Way with Sam Ball and Jonathan McEwen. If you enjoy the show, please subscribe and follow us on Twitter at TIWTweets.
Hello and welcome to The Investor Way with myself, John McEwen, my co-host Sam Ball. This week on The Investor Way, we have Associated British Foods, Halma, PZ Cussons, Baltic, Moonpig, and our US company of the week is Blackberry. Sam, shall I kick us off with ABF?
Absolutely. Favourite of the show.
Very much so. So, for anyone who doesn't know, it's the parent company of Primark, which is the main part of its business, although it does have some other parts, and we will come to those. They had their third quarter trading statement out with third quarter revenue up 16% to £4.7 billion, ignoring exchange rates, with all categories seeing positive growth. Primark continued to trade in line with expectations and sales grew 13%. 319 million of the £500 million share buyback has now been completed. And just breaking those results down a little bit further, so as previously mentioned, retail, which is essentially the form of Primark, was up just below 2 billion, 13% at constant currency. Total food was up to 2.7 billion, which is an 18% increase. If we break food down further, in grocery, that was up to just over £1 billion, up 13%. Sugar, up to £665 million, which is a 51% revenue increase at constant currency. Agriculture up 4% to £458 million, and ingredients up 10% to £547 million. And commenting on the food trading across the food business, it's continued to be good following the trends seen in our second quarter. In particular, they've seen strong currency sales growth in grocery and ingredients, largely driven by necessary pricing actions taken in earlier in the year to offset input cost increases. And in sugar, trading has continued to be strong in its key African markets. As they previously announced, British Sugar has secured alternative sources of supply as a consequence of the production shortfall from the 2022 to 2023 campaign. And after delaying planting, the 2023 UK beet sugar crop is now progressing well. In terms of retail, Primark continue to trade in line with their expectations, with summer ranges performing well as the season started in the markets. As mentioned before, sales grew 13% in the quarter, with like-for-like sales growth of 7%, supported by higher average selling prices. Like-for-like sales growth for the year to date is now 9%. And like-for-like sales growth in the quarter was 6% in the UK and 7% in Europe, excluding the UK. As well as seasonal clothing and accessories, sales in health and beauty products were particularly strong, and sales in the flagship city centre stores have continued to be good. The deployment of Primark's much improved website continued launching in Germany, Spain, Italy and the US in the period, and in France shortly after the period ended. The remaining markets will now follow over from the summer. The contribution from new and extended stores continues to be strong. Have an exciting store expansion plan, which remains on track. They've opened 4 stores in the period in Venice, in Italy, in Buffalo, in Spain, and in Slovakia, the first country which becomes their 16th market. And in the US, they've now signed the lease for their first store in Texas. And overall, the group continues to trade well based on the current trading conditions, now expecting the group's adjusted operating profit to be in the full year moderately ahead of last year. Adjusted earnings per share will also benefit from the group effective tax rate that's now expected to be below than that seen in the first half of the year. In terms of valuation, ABF has a market cap of £15.5 billion and trades at 13 times forward earnings, below its 10-year average of around 20, and it has a prospective dividend yield of 2.5%. I thought these results were very good in what are tricky macroeconomic conditions. And whilst the group has been hesitant to pass on more of the cost to their price-conscious customers, they have done a good job of it. And with those numbers and the revenues in this environment, I think is really impressive. It's also, I think, quite an exciting business with touched on this a few times, and I know some of our listeners have engaged over it, with some of that growth, particularly overseas and in the US, where it seems to be going down very well. I know we cover a few companies that or British companies that operate in the US, and some of them are phenomenally expensive, thinking about, Fevertree, for example. ABF isn't one of them. It performs strongly in the UK, which is its primary market, but also I think that growth isn't really at the moment baked into the price. And it's really for that reason that I like it. I do like the products, but also I think the valuation and the room for expansion and growth is really exciting. I've said it a few times and it's still on my watch list. I don't know why I haven't pulled the trigger, but I'm probably more likely to do so after this quarterly trading statement, I think. Sam, what are your thoughts on these results and Associated British Foods as a company?
I think it's a very good trading statement. It's above inflation by quite a bit. I do like it. I like the business. I like the diversification. Primark seems to be doing very well. It seems to be doing well internationally. I think the last couple of times we've covered it, we've talked about the US expansion and that they do seem to be ramping that up. And it has been going well. And then overseas, you do just like in Europe, for example, you do just see Primarks everywhere. It's surprising just how big they are. I do like the business. I think the valuation at a forward P of 13.4 looks pretty good. And I think if it just stays flat, it's quite reasonably valued. So then if on top of that, the US figures get better and better, I don't really feel like that risk is included in the price. I do really like it. I just wouldn't want any more retail exposure. That's the main issue for me. I wouldn't want a portfolio with Boohoo and Primark in. I probably should have bought Primark over Boohoo in hindsight, but here we are. But I wouldn't increase the retail exposure, but it is a top quality stock. I think it's one of the best stocks listed on the FTSE 100. I do like it. What do you think of the valuation compared to previous times we've covered it?
I mean, it's cheaper. I think it's very attractive. And yeah, like you say, you've got quite a lot of safety there in the sense that it is just over 13 times earnings. So even if things stayed flat, I was just going to come back on the point you mentioned about Boohoo and your retail exposure. I'm a Boohoo shareholder as well, and I know how far the shares have come down.
Bagholder rather than shareholder at this point.
Okay. But presumably with the share price fall of Boohoo, it doesn't make up much of your portfolio now. So why, on that basis, wouldn't you go in for ABF?
Although it doesn't make up much, it's still noticeable. I think it must still be at least a couple of percent. I don't have a hugely I don't have a hugely diversified portfolio anyway. My portfolio is pretty concentrated. I know it sounds silly, but psychologically having I think I have under 15 stocks, and the thought of two of them being retail is just, I mean, I know what I'm talking about, and it's I really like ABF, I really don't like Boohoo. The obvious answer is, well, why don't you sell Boohoo? But I just I don't want to crystallize a 2/3 loss because I just think it's bad practice. I've had it for a year or two. I've not had it that long. It might go back up, it might not, but I think to sell it at this point would just be poor. It would just be creating a bad habit. So as much as I think Associated British Foods, it's one of the best stocks I don't own, but there's other ones I'd consider as well. So that I would like to have next in the portfolio. And again, it's kind of the same issue. But if I was to have the funds for a couple more stocks, Associated British Foods next, I'd certainly have a very strong look at them. But there's quite a few businesses like that I do like.
But you wouldn't say take a basket approach and say, okay, well, I've got, you have had your Boohoo exposure and it now makes up a much smaller part of your portfolio. You wouldn't say, well, I'll put X amount, I'll split it between, say, ABF and Next and have that as, with Boohoo as the retail part of, or the retail exposure in my portfolio.
Not for my personal portfolio, but that's partly to do with the way I run it. So the way I run it is, at the minute, I want my US allocation to be higher. So all the new funds that are going in now are going into, they can only be used for US stocks. I want to get that allocation up just because it has drifted slightly below the UK one now. So I'm probably, so between 60 and 66% UK, I reckon. So I'd like to increase the US. So it's not going to be from new funds, not until probably the next tax year at least. So I would have to sell something I've already got. And there's nothing in there that's obvious that I'd want to sell.
Okay.
Where it wouldn't be. The only thing I'd maybe sell would be Hargreaves Lansdowne, but that's worth like 1.5% of my portfolio anyway. So it's like, if I've got a new position that I like, I would want the position to be big enough that if it does well, I actually benefit. Whereas if I put 1.5% into Associated British Foods, even if it doubles, I've made 1.5%. I'm not really going to notice it.
Yeah.
So it's like a fund,
Fine.
really.
Okay. Fine. Let's move on. Halma.
Yes, so Halma, this is a debut on the show, and it's not a company I'd actually previously heard of. So I'll go through who they are, and this is all per their website, so take it with a pinch of salt. And it is. I'll try and just get the key facts in there, but they do like to talk about themselves on their website. So if you do want to know more about them, that's probably a good place to go. So Halma employs over 7,000 people in more than 20 countries, and they are listed on the FTSE 100, and their purpose is to grow a safer, cleaner, healthier future for everyone every day. They talk a lot about their sustainable growth model, which I won't go into. And then in terms of the companies, you see, our companies are the heroes. Their life-saving technology delivers our purpose and create positive impact for everyone every day. They provide innovative solutions that are tackling many of the urgent problems of our time, from water pollution to chronic illness. They have over 45 companies, smaller companies in their group, and they say that our companies are small to medium-sized technology businesses who are united by our purpose. So they range from high-tech software companies to hardware companies operating in the safety, environmental, and healthcare markets. Many of them are founder-led companies who've chosen to join Halma to help them grow. Our unique model attracts these privately owned businesses as we can help them get to the next level of growth while retaining their unique brand and culture. And then in terms of the recent acquisition history, so as mentioned, they are all in the safety, environmental, and healthcare markets. So for me, it's not really a company I've ever heard of. But if we use the latest acquisition, that was May 23, and that was Sewertronics. And they repair and rehabilitate wastewater pipelines without the need to dig a trench. Prior to that, March 23, that was FirePro, and they are a leading designer and manufacturer in aerosol fire suppression systems. Thermocable, February 23, based in Bradford, actually, but they are a leading developer and manufacturer of linear heat detectors, which are temperature-sensitive cables installed in areas of risk of overheating and fire. So it does look quite interesting. It reminds me a bit of Gamma, actually. It's quite acquisitive, and it seems quite complicated as well. So they have come out with full year results, and they've reported record full year revenue of 1.9 billion, up 21.5%, with broad-based growth. In the mix, there were benefits from the weakness in sterling and recent acquisitions, which helped contribute 8.1% and 3.2% respectively. So 8.1% of that 21.5% growth is due to exchange rate movements. Organic revenue growth, ignoring exchange rates, was 10.2%. Underlying profit before tax grew 14.2% to 361 million, largely due to higher revenue, which was somewhat offset by higher finance costs and supply chain disruptions. That reflects organic growth, ignoring exchange rates, at 3.1%. There were also benefits from the weakness in sterling and acquisitions, which were 9% and 2.1% respectively. Cash conversion improved in the second half, with free cash flow for the year of 232 million, up 9%. Record levels of investment meant net debt more than doubled to 597 million, which is 1.38 times cash profits. In the coming year, the group expects to deliver good organic revenue growth, ignoring exchange rates, with a small uptick in profitability. There was some weakness in margins due to supply chain disruptions, particularly in the safety sector, and these results represent their 20th consecutive year of record profits. The cash conversion of the first half was 63%, and that compared to a 90% target. And that's due to inventory spend to support supply chains. Apparently, they have quite a promising deal pipeline in terms of the deals that they've got coming up. One thing I don't like is they have been taking on debt to fund these acquisitions. The debt is not at a concerning level, so it's only 1.4 times cash profits, nowhere near the level where we'd be concerned. What I don't like, they're taking on debt to fund these acquisitions, and then they're also paying out 30% of their cash to shareholders every year. And that gives a yield of less than 1% as well. So it's kind of like, well, that cash could clearly be better used. Why aren't they using it? It does frustrate me. It's one of my pet peeves of investing. So in terms of valuation, they trade at a forward PE ratio of 29.7, and that compares to a 10-year average of 28.5. My thoughts were this is an interesting company. It's always nice to have a debut on the show. It does remind me of Gamma quite a lot, actually, and it's very complicated, and it's doing a lot of acquisitions to improve the growth. I've already got Gamma. I'm probably quite close to selling it, actually, just because I've thought about it the last few months, and I think despite the time I've put into trying to understand it, I still don't understand it particularly well. I wouldn't want something like this, which for me, I think is probably a bit too complicated. And as well, it's for the results it's putting up, considering it's all funded by acquisitions anyway, the organic growth, it is good, but at 30 times earnings, maybe if it was cheaper, I'd take another look at it, but for me, it doesn't really. There's better businesses for 30 times earnings, but on the surface, it looked quite good. John, what are your thoughts on the company and the valuation?
Yeah, it's one that I'd need to dig into a lot further, like you say, to fully understand it and see what the sort it was in further detail. I suppose some of those companies that it forms part of. The other thing is the price too. It's very expensive, so I think if you were paying up that much, again, you really have to understand some of these businesses and I guess the overall strategy. I don't like, some of those things and taking on debts for the acquisitions, but also paying out, a dividend. It doesn't make that much sense. So I think there would probably be a couple of red flags there for me. It's one that I need to dig into, and I don't know just on the surface of it whether it sounds like it would be something worthwhile putting the effort into. Probably not for me. Interesting what you say about Gamma. I hadn't appreciated you were thinking about selling that. What's the main reason? Is it the understanding of it as a company, or how it's been performing? What is it?
So it's the understanding. So when I did the interview with Ben Bennett a month or two ago, he was talking about Gamma because he previously owned it, and he worked in it's quite technical. It's like he works in cybersecurity. He said he was using the products every day, and he still didn't understand what they did. So I was just like, it did make me think, and I was kind of like, well, genuinely, what chance have I got? And I have, earlier on when I first bought it, I spent quite a bit of time going through and trying to understand everything and what the products do. And then you go back 6-12 months later and look at the results, and I can't remember. I don't remember what an SIP trunk is now. I know it's part of the technology, but I can't really tell you what it does. I think it sort of connects phones over the internet, but considering I've put my own money into that, I should be able to talk a bit more about it. So it's just, whereas I've got some other businesses where they're just much simpler, they're much easier to understand, and there's other businesses I would like to own more of. And as well, Gamma, it's not done fantastically. It's probably it's maybe down 17%, but I've maybe had 3 or 4% of dividends over the time I've owned it. So it's not terrible. It's down 10-15% in total.
Okay.
But it's quite a sizable chunk of my portfolio. It's probably maybe 4 or 5% or something. And it's again, there's companies I would rather own, and there's companies I own now that I would rather own more of than something that it does make it's a sort of eat at night, sleep at night thing. I do sleep at night fine, but the fact that I've got Gamma in the portfolio is a concern because I need to be able to keep an eye on it, and I don't have the technical ability to do it.
Yeah. Okay. Fine.
Which is a shame because I do like the business.
That makes sense. Interesting. Very interesting. Okay. Enough said on Halma?
I think so, yeah. Should we move on to PZ Cussons?
Yes. I wouldn't say it's a favourite of the show. We have covered it quite a few times now. It's one of the consumer goods companies. I'm just thinking, actually, is it the third biggest in the UK? I think it must be. It's on the FTSE 250. It has brands from Original Source, Imperial Leather. They're probably the ones that you would know, or the best known ones. It's also got Carex hand gels. Anyway, they had their fourth quarter trading statement out last week with, well, mixed news. The group like-for-like revenue growth was 6.7%, resulting in 6.1% like-for-like growth for full year 2023. And full year group revenue is expected to be approximately £655 million, with like-for-like revenue growth in each geographic region in the fourth quarter. Adjusted profit before tax of at least 70 million, reflecting particularly strong growth in Q4 performance within Africa. And as anticipated, Europe and the Americas operating margin returned to the high teens in the second half. And there's been progress with a strategy, including the majority of their must-win brands in revenue growth in full year 23. Child's Farm delivered 12% revenue growth in the first full year of ownership, and further geographic expansion with the launch of Original Source into Spain this month. The more mixed part, and why the shares were down 7% on the day, was in relation to the changes in foreign exchange policy in Nigeria. The group welcomes the recent policy announcement by the Central Bank of Nigeria to liberalise the foreign exchange regime, which, as part of the broader suite of economic reforms under the new government, is highly likely to improve the longer-term prospects of Nigeria and remove some of the cash challenges faced by multinational companies. This has, however, resulted in the devaluation of the Naira since the announcement of the 14th of June. The following information is provided to allow an assessment of the impacts of this devaluation in the near-term future financial performance in full year 24, recognising that the exchange rates in Nigeria are currently highly volatile. There is not expected to be any impact on their audited full year 23 results, but the following is quite technical. So the Naira versus the pound, average rate used to translate full year 23 results of the Nigerian business in the group's income statement was 536, implied Naira to USD of 446, and the Naira to the pound closing rate used for the group's balance sheet as of the 31st of May 23 was 577, implied Naira to USD rate of 465. As a sensitivity, every 10% devaluation in the Naira from the rate used to translate the full year 23 income statement is estimated to result in a £23 million reduction in revenue, £3 million reduction in adjusted operating profit, and 0.5 pence reduction in adjusted earnings per share. Every 10% devaluation in the Naira from the closing rate used to translate the balance sheet as of the 31st of May 23 is estimated to reduce the group cash balance as reported in pounds by approximately £20 million. The devaluation of the Naira will also translate into US-denominated liabilities of their Nigerian business, and the adverse impact being recorded within the statutory profit or reserves in the group's financial statements in full year 24. While the devaluation of the Naira will result in higher raw material costs for the Nigerian business, reflecting the higher cost of US imports, they're expected to largely offset this through mitigating actions such as price rises, as successfully demonstrated in the last 2 years. And management believes that the group will be well placed to withstand any macroeconomic volatility in Nigeria, given their current market position and the significant improvement in the profitability of the business in recent years. It has moved from an operating loss in full year 20 to an operating margin of more than 10% in full year 23, and they've also strengthened the local capabilities substantially. The group is committed to improving performance of the Nigerian business further, given the significant market opportunity and the strength of their brands. And like I say, shares or the market not being impressed with the news. I mean, excluding the Naira devaluation, I didn't think the results were bad. And it is certainly a business that's being turned around. They're certainly not up there with the likes of Unilever, Nestle, and even Reckitt. They're quite some way off. In terms of the valuation, it's trading at 12 times earnings. and it's a lot smaller as a company. It's only got a market cap of 685 million and prospective yield of 4%. For me, the issues with the currency, Nigeria, and not having the same quality of brands, although it does have, with original source and Imperial Leather, some strong ones, I just wouldn't really go near it on the back of that, and it would put me off. It never stood out to me as a company, and I think the valuation was largely because we've got it in the UK and in Europe, a lot of consumer goods companies to choose from, and it's never been significantly enough discounted. And on the back of this, with currency headaches, that I think that would be the nail in the coffin for me, probably for some considerable time. I mean, the business may be able to change things strategically with where it's located and I suppose where some of the revenue comes from. But even if you looked at it from, well, has PZ Cussons got a lot more emerging markets exposure? I think you get a decent amount when you look at companies like Unilever. They've got a lot or most of the revenue coming from abroad and from some of those emerging markets. So I would be very happy, owning a Unilever and pay up for it. It's still not that expensive, higher in the teens. I think with that, you maintain both the sort of, I suppose, traditional Western markets and those emerging markets. It's not, for example, like Kraft Heinz, which is, vast majority of the revenue comes from the US. You've got still exciting consumer goods companies which have the emerging markets exposure and don't have the issues that PZ Cussons have. So for me, it wouldn't be one that I'd be looking at. Probably interesting to follow, but wouldn't seriously look at it probably for a long time until this is, these issues are well resolved. And I don't think there's a huge amount of value there. It's certainly not cheap enough to try and go bargain hunting, I don't think. Sam, what are your thoughts on the back of this trading statement?
I wasn't that impressed with it. I thought it's hard because they have been so adversely affected by currency, but I thought the results were a bit lackluster. They always are. So we can't just blame the currency movements. I think it does have some good brands, but Unilever and Reckitt have better brands. They have more of them. They're bigger brands. Actually, it has come down quite a bit, hasn't it? It's down 25% in the last 6 months, actually. So it's cheaper than the last few times we've covered it. But even still, I mean, like previously we've covered it and I've said, well, actually, it's not that much of a discount compared to Unilever and Reckitt. It now is at a decent discount, but I'd say it's discounted for a reason. I would still rather pay up for the quality brands. One thing that I think is interesting is Nigeria is Airtel Africa's biggest market. So I'd already seen some stuff about that, but we will see a hit in the next set of our Airtel results. So hopefully these reforms do actually lead to some long-term improvement. Otherwise, Airtel Africa will just be taking a hit for nothing. But that is the risk of companies that operate in markets such as Nigeria.
And I mean, I suppose coming back on that to some extent, Airtel it's much more of a growth company, and it hasn't been that expensive. So it feels like with Airtel, it was more baked into the price. Whereas with PZ Cussons, like you say, I know there is a bit of a bigger gap in terms of the discount compared with some of its peers, but it wasn't that much. It was still higher up in the teens when we covered it before.
Yeah, I agree. And I think with Airtel as well, prior to the devaluation, Boyd had been putting up the figures. PZ Cussons hasn't. So I don't mind as a shareholder taking a little bit of pain with Airtel for a while on it. Whereas with PZ Cussons, I wouldn't invest on it on the back of this. It's just more probably bad news on top of several years of poor results as well compared to its peers.
Yeah, and I don't really like the term, but it maybe was one of those companies that you'd see in the sort of bond proxy stocks, and you certainly wouldn't be buying it for that. And this is the sort of reason why.
Yeah, it does have some decent brands though, but it's just not for me. I wouldn't ever be interested in it, I don't think.
Baltic?
Yes, so it's a company we have covered once before and we quite liked, actually. So just as a reminder, it's got several websites in the Baltic countries. So Lithuania, Estonia, Latvia, I think are the 3 countries it seems to have a presence in. It's got various websites in automotive, real estate, jobs and services, and general. So it's kind of like the Baltic, Auto Trader, Rightmove, Indeed, and maybe Craigslist or something. So it's a company we covered before. We do like the websites. We do like I did like the business last time. I did really like the look of it. So it's come out with its full year results now. And this is for the year ended 30 April 2023. And all these figures will be in euros, but the business is listed in the UK on the FTSE 250. So revenue was up from 51 to 60.8 million, and that's an increase of 19%. Operating profit is up 113% to 29.1 million, and that gives a 48% operating profit margin. I should add the reason the operating profit is up so much more than the revenue is because last year there were expenses relating to the IPO. So if you use the adjusted operating profit, which strips out the amortization and also the IPO fees in the comparatives, the operating profit's only up 17%. However, that gives an adjusted operating profit of 45.3 million. Adjusted EPS is up 20% to 7.7 cents a share. And they said our core classified revenue streams of business to consumer and consumer to consumer, which together comprise 88% of total revenue, grew 21% and 25% respectively. By business line, growth was also consistently strong, with auto up 22%, real estate up 21%, jobs and services up 20%, and generalists up 13%. Cash conversion maintained at 99%. Cash generated from operating activities, when adjusted for IPO fees in 2022, grew 18% from 40.5 million to 48 million. Net debt fell by 21.1 million to 45.3 million. And we ended the year with leverage at 1 times, doesn't say 1 times what, but it's usually either operating profit or adjusted operating profit or EBITDA or something like that. But either way, 1 times, it doesn't really matter what it's 1 times because it's so low, you wouldn't worry about it, especially the amount of cash this thing generates. 14 million of gross debt was repaid in 2023 and 3.4 million of shares repurchased since the buyback program began in October. That's not very much at all, but what's the market cap? 900 million, yeah, that's nothing. Traffic to our sites averaged 61.9 million visits per month, meaning the Baltic population visited our sites 11 times every month. We maintained a significant leadership position over the nearest competitor for all our largest sites compared to 2022. Autoplius at 5x the nearest competitor, Auto24 at 29.2x, Aroudus at 20.7x, Skelbiu at 19.3x, KV plus City 24 in Estonia. It's not the best names, I do have to say, at 16.4x, and CV Banker 8.6x. In terms of customer numbers, automotive dealers grew 3%, real estate brokers were flat, and job customers fell slightly on last year, -4%, albeit have grown very strongly over the last 2 years, up 42%. We have more active ads in all of these business lines. They showed a graph in the slides of the revenue and how that's done quarter to quarter, and even in COVID, this thing barely takes a hit. All revenue really does is slow, actually. There's not huge drops. It's pretty consistent, as you expect with these kind of businesses. And as well, they've highlighted that for the 3 countries they operate in, the historical growth of these countries is higher than the EU average, 4.9% for Lithuania, 3.6% for Estonia, and 4.3% for Latvia, and that compares to an EU average of 1.1%. And they also have high inflation compared to the EU average, with 9% in Lithuania, 9% in Estonia, and 9% in Latvia. And the EU has 5.4% at the minute, which I was surprised by how low that is. But anyway, in terms of the valuation, the business trades at a PE ratio of 30 and has a dividend yield of 1.14%. My view is I liked the business last time. Now we've covered it again. I really like it. I really, really like this business. It's just a market leader in so many great fields, so many fields where it's, if we look at some of the best businesses we've got listed in the UK, Auto Trader would be up there, Rightmove would be up there. They just churn out cash, and this has the Baltic equivalent of both of them, and it's so dominant in the markets based on what it's giving us. What I don't like is the price. And also, I don't know how big the Baltic markets are going to get. And it doesn't seem like the kind of company that's going to grow out. I mean, it's called Baltic Classifieds Group. It doesn't seem like they're going to go and take over Europe. And then I think if you go into Europe, in other parts of Europe, they're going to have their own entrenched market leaders anyway, kind of like we've got Rightmove and Auto Trader in the UK. Like, if you want to come in and knock Rightmove off their perch, good luck to you, because it's just not going to happen. And I think you've got the same if you go to the Baltics, but you are relying on the growth in those countries. And I think at a PE of 30, it has to grow a lot to justify it. I really, really like the business, though. If this thing pulled back a bit in terms of price, I would take a serious look at this, because I really like this business. It's definitely going on my watch list, but I just wouldn't pay 30 times earnings for a business that is purely based in the Baltic countries. John, what are your thoughts on the results and the valuation?
Yeah, I think fairly similar. You can't fault the results. I suppose it is the growth potential, and it's certainly priced for it. But how big can that market be just in the Baltics? Very difficult to know. I do like it a lot, and certainly going on my watch list as well.
Yeah, I think if it drops like, say, 20 times earnings, I'd maybe take a look at it. But at 29, I think last time we covered it, it was like 25. So it's just, even that for me would probably be too pricey.
Yeah, very tricky, but looks like a fantastic company.
Yeah, and nice to have it listed in the UK. So at least now we will get to have a look at it every 6 months. So at some point, it might be a bit cheaper.
And there are some gems in there that you don't hear about day to day. So Moonpig is probably one that most people have heard of, certainly here in the UK. It's the market leader, has about 70% of the market share in the UK custom cards market. They had their full year results out last week, with revenue up 5.2% year on year to £320.1 million, and adjusted EBITDA growing 12.4% to £84.2 million, with a gross margin rate of 56% and 26.3% adjusted margin. This was largely a result of experiences, which added £42 million to revenues, as Moonpig revenue itself fell by 5% to £223 million, and Greets, which is the business in the Netherlands, revenue fell by 20% to £55 million. Debt also fell to £167.7 million from £208 million. Average order value was up 8% across Moonpig and Greets to £8.20, with card price changes, more targeted promotions and upselling, offset in part by lower average prices for gifting. And total orders were actually down by 15%, which the group attributes to the COVID boost, giving tough comparators, the wider economic environment and the industrial action by the Royal Mail. Existing customers represented 89% of total revenue, but new customer revenue was still at 33% ahead of pre-pandemic levels. And the group stressed that they see single greeting card market as being resilient to recession, which is fairly bold claim. The card pricing changes, the new Tamworth facility and smart technology with targeted advertising helped gross margins increase to the headline 56%. Operating cash flow came in at £56.2 million, with an operating cash conversion of 111%. And debt also fell to £167.7 million from £208 million in the prior year, with net leverage decreasing to 1.97 times. Going forward, trading since the start of the year has been in line with their expectations. And in the context of the current macroeconomic environment, they expect pro forma revenue to grow at low single-digit percentage rate in the first half of full year 24, underpinned by the Moonpig brand, which has been in growth since March. And for the full financial year, they expect consolidated revenue growth at a mid to high single-digit percentage rate, with all of their brands returning to growth for the second half. And the adjusted EBITDA margin is expected to remain resilient. In terms of valuation, Moonpig has a market cap of £546 million and trades at 23 times earnings. It doesn't currently pay a dividend. I thought these results were slightly disappointing, but probably to be expected in the wider economic environment. I think the customers have proved stickier, and the group has shown that they've been able to grow the market share fairly consistently from 60% pre-pandemic to 70% of market share in the UK currently, which is nearly 6 times bigger than the nearest competitor. Similar story in the Dutch business, which has a market share of 67% and around 3 times bigger than the nearest competitor. It's certainly not cheap, and I think given the valuation, the numbers are disappointing. I know they'd adjusted for some cost associated with the relatively recent IPO. I don't think it's a business that I would go any further with, and it's certainly going to be challenging, I think, over the next couple of years. The experience is a more interesting part of the business, and the margins on that are fantastic. They've certainly helped with what would have otherwise been really, I think, quite disappointing numbers here. It's not one for me. What are your thoughts on Moonpig and these results?
I think it's more based on where the business is potentially going. Like you say, the margins on the experiences are much better. Could they be in a position where they've got that almost like the cards as like a loss leader, and they're making money on the experiences, and that's just a way of pulling you in? I don't think it's a terrible business model. I think it's a much better business model than when it was just cards. I didn't realise they were that much. How much bigger are they than Funky Pigeon?
Nearly 5.8 times.
I had no idea it was that big. I thought they were like roughly the same in my head. I know we've probably covered it before, but I didn't realise, especially given I thought they're fairly interchangeable products, but I suppose you've kind of got that with other businesses, haven't you? Once you've got one that's got some kind of scale, so you can just outspend on advertising as well, can't they? So just crush them into oblivion. But yeah, it is obviously dominant. It's a market that's probably not going to go away. I think people will continue to get lazier. So I think being able to, it is very convenient. I actually use Funky Pigeon, not Moonpig, but it is quite convenient. It is quite a good product, and you can get better cards as well than you'd get in like a store or something. And if you could get an experience alongside it, because when you look at the gifts are always like a bit naff. So unless it's like you're just going for like some generic chocolates or something, I wouldn't but like I wouldn't ever go for the gifts. Whereas like an experience you possibly would pay for. So yeah, I think although the results are not fantastic, I think it'll be interesting to see where the business goes. And if you do like the future of it, I think now's probably not a bad time to buy in, because you are getting it at a fairly cheap valuation. It's down 25% in the last year, and in the last 2 years it's down 62%. So yeah, if you think the experiences will do very well, it's pretty cheap, I think. But for me, it's just there's so many other businesses I would want to buy before I took a serious look at Moonpig.
Yeah, no, fair enough. I think would echo that really. What about Blackberry then?
So Blackberry, a business that I'm sure needs no introduction. They used to make mobile phones, and
I think Sam, if you're Gen Z, you may not have heard, or you may be asking, what is a Blackberry?
We don't have many Gen Zs listening. They're not at that age range where they've started investing yet. Wait, I'll just get the demographics off.
Can you buy it on Robinhood?
I don't know. Yeah, I don't know. It's US listed, so there's a good chance, isn't there? But let's see, audience. Here we go. We are less than 1% 0 to 17 age range, 2% 18 to 22, and then 23 to 27, we go up to 13%. But this is very much a millennial, Gen X and boomer podcast. This is not for the Zoomers. But if you've got any Zoomers listening, we're very happy to have you. And for those who don't know, Blackberries used to make mobile phones that were like the work phone. They had a keypad, which at the time was very cool, and they had the messaging app BBM that was all the rage back in like the mid noughties. And then the iPhone came out, and the rest is history. So Blackberry, they do still exist, for those who are surprised to hear of them, and they are listed in the US, although it's actually a Canadian company. But they have come out with their first quarter results. Firstly, I'd like to point out the results were quite difficult to actually get through, in that they didn't give you comparatives or anything. And I just think I don't like it when companies do that. And I just think it's poor. And usually it's because they've not got much to brag about. But anyway, total revenue was 373 million. That was basically more than double last year, but that's because they've been selling patent rights, so it's a bit artificial. Total company GAAP and non-GAAP gross margin was 48%, both lower due to completion of significant sale of non-core portion of the patent portfolio in the quarter. Excluding the patent sale, non-GAAP gross margin was 22% higher. Internet of Things revenue was 45 million with gross margin of 80%, no comparative, which isn't particularly helpful. Cybersecurity revenue was 93 million with gross margin of 60% and annualized recurring revenue of 289 million. Again, some comparatives would be nice. Cybersecurity billings were 122 million, increasing for the fourth consecutive quarter with 14% sequential and 37% year-over-year growth. Licensing and other revenue was 235 million, including 218 million relating to the patent sale. So there it is. So 218 million of the 373 is from the patent sale. Total cash equivalent, short-term and long-term investments increased by 91 million to 578 million. And in the business highlights, they've said BlackBerry QNX software is now embedded in over 235 million vehicles worldwide, a year-over-year net increase of 20 million vehicles. I don't really understand what it does, but that's very impressive. The upstream security joined the BlackBerry IVY partner ecosystem, leveraging IVY's rich telemetry data to edge computing capabilities to protect software-defined vehicles from cyber threats. So it must be like cybersecurity and stuff for the vehicles. BlackBerry launches enhanced AI-based Cyclant cybersecurity solutions portfolio, reducing alert fatigue, offering faster incident response and expanding cloud defense coverage. McKinsey names BlackBerry a cybersecurity and Internet of Things convergence leader, well positioned in an addressable market of up to 750 billion by 2030. Now, I did put a note here that mobile phones had a pretty big market as well, so that's not really, it's certainly not a guarantee. So I didn't spend a huge amount looking at this company because I just think if they're selling off patent rights and stuff, it's not, I guess they might be streamlining the business, but when you look at the revenue and how it's done per share over the last few years, so if we go to that, 2011 revenue per share was $37 per share, and that's dropped to $1.13 since then. Free cash flow per share in 2011 was $4.50, and that's dropped to a 53-cent loss in the last year. And these figures just go on. It's just a business that has shrunk massively. I mean, the share price, 2008, was about 145. It's now 5. Trades at a forward P of 130 and has a market cap of 3 billion. I wouldn't invest in it based on the valuation anyway, but it's a declining business. It looks like it has managed to carve out a little niche for itself in like cybersecurity for vehicles. And, you know, it's nice to see it's not dead, but at the same time, it goes in the too hard pile anyway. But even if it didn't, it doesn't seem like there's nothing jumping out at me where it's like sometimes you see a business that goes in the too hard pile and you sort of think, well, if I understood that, that'd probably be quite a good business on the surface. Whereas with BlackBerry, I'm not really getting that. Although it may well be, and I could be wrong, but more just interesting to see where it is now, but not something I'd consider investing in. John, what are your thoughts on the results and the business?
Yeah, largely the same. Not that easy to interpret, but it's a business now that's certainly very difficult to understand. I hope it does do well. I did used to have a BlackBerry, but it's not one that I'd be buying shares in. And yeah, they were all the rage in sort of 2008. Barack Obama had them. And then, yeah, like you say, with the growth of the iPhone and Android, they just went completely. And it was a pretty rapid drop off. And I don't know anybody who uses about BlackBerry these days, but I suppose it is about the services now and some of those, I suppose, specialist security services that they do offer. But yeah, like I say, too hard and not one that I'd want to look at any further.
So in that case, of the 6 businesses we've covered this week, ABF, Halma, PZ Cussons, Baltic Classified Group, Moonpig and BlackBerry, which one do you like the most and which one do you like the least?
Pretty straightforward. I would go with ABF as my first choice, and the one I like the least is BlackBerry.
I would go with Baltic Classifieds as my first choice, and again, BlackBerry was a clear loser for me. Before we finish off, I would like to shout out as well Ben Bennett, superhero and investor. So he was on the show, I don't know, like a month or so ago for a couple of interviews, and he has just set up a Birmingham Value Investors Club to network and share knowledge with those in the Midlands area. Their first low-key event will kick off in August, and it is on a weeknight, but if anyone would be interested in attending in the Midlands area, or from wider afield if you want to travel for it, we have retweeted on our Twitter the link that he's put to the meetup. So if you just go onto TIW tweets on Twitter or twitter.com/TIW tweets, if you don't normally use it, you can then get the link from that. Or I would say as well, whilst I've got it in my head, but in the whole time that we've ran this podcast, we've never once asked anyone to give us a review. Unfortunately, we do have quite good reviews anyway. But just whilst it's in my head, if you could give us a rating and a review on the platform you listen, that would be very nice, because we've never actually encouraged that from our listeners. So please do. So, John, that's the end of my announcements.
Thank you again for listening, and we'll see you again next week.
See you next week.
Thank you for listening to The Investor Way. To get in touch, please follow us on Twitter at TIW Tweets. This podcast is for entertainment purposes only and does not constitute financial advice. Neither Sam nor Jonathan are financial advisors. For investment advice, please consult professional advisors.